Hello, everyone. Welcome to CRI's 2023 GASB update. Thank you all so much for joining us this morning. Our governmental team spends a great amount of time planning and organizing governmental CPE sessions each quarter that we hope provide value to you and help us to help you to keep up with all the latest developments in the governmental accounting and auditing space. Please visit our website, go to our government and public sector industry section, where we have some great content on all the latest information that's going on in the governmental industry. We are pleased to offer you 2 credits of CPE today, and this is in the accounting governmental field of study. Please make sure that you are logged in with your unique link. Remember that you must answer 80% of the poll questions, which I believe is actually 7 of the 8 polling questions, not 6. We will be distributing these certificates to you via email within 7 days of this event. These will be delivered from our support at prolera.com. So be on the lookout for that. Make sure to check your junk email, just in case it goes to your junk. And any questions about this certification process can be sent to our marketing@cricpa.com address. Our PDF presentation slides will be accessible in our Zoom chat for download, and that is available now. We are so pleased to have 2 wonderful presenters today. We have Dean Michael Mead, who's a partner in our government and public sector subline with our corporate office, and also Tina Stewart, who's also a partner with our corporate office. And I am Becky Hammond, partner with our New Orleans office. I'm also a member of the government and public sector subline. So I'm going to go ahead and hand it over to Dean and Tina.
Thank you, Becky. Good morning, everyone. This is what we're planning to cover today in broad strokes. Start by just providing an overview of the effective dates of pronouncements that governments are working on right now or will be working on over the next several years. Talk a little bit about a related topic, which is changes in the GASB's technical agenda that you may see if you've been following that, and then move on to talk about the status of several ongoing GASB projects, including those related to classification of non-financial assets, revenue and expense recognition, risks and uncertainties disclosures, the financial reporting model, and others. Then we would like to spend a little bit of time talking about the implementation guidance update that GASB issued in June and highlighting some of the key takeaways from the questions and answers that GASB issued then, and then wrap things up before a Q&A session by focusing on implementation issues that are coming up related to Statement 96, which governments are implementing right now, and some lessons that have been learned from the prior implementation of the leases standards under Statement 87. So looking at the effective dates of pronouncements coming up over the next several years, this is this and the next 2 slides based on slides that were designed by the GASB and which I think are absolutely terrific. And so it clearly says on there that I stole them from GASB using more polite language. But in addition to setting the context for talking about pronouncements that governments are dealing with now and over the next several years, this visually emphasizes 4 really important things to keep in mind. The first is that not all GASB statements are created equal. If you look here at this, the color indication of the amount of effort that GASB expects governments will need to make with these pronouncements, only Statement 96 on subscription-based information technology arrangements, or SBITAs, is identified as requiring a large effort from most governments. Statement 94 is a medium effort related to public-private and public-public partnerships. And Statement 101 really is kind of a mixed bag. It may be a heavy lift for some governments, and for other governments, it may be very easy to implement, depending upon, in part, whether a government has a large balance of leave that can be used during employment prior to retirement, or otherwise leaving the employment of the government, which is one of the significant differences between Statement 101's treatment of compensated absences and Statement 16. The second point is that not all statements are applicable to all governments. So you look at this and you see that there are 9 pronouncements here, but in fact, many of them may not apply to your government or to your government clients. Statement 91, for instance, on conduit debt only applies to governments that issue conduit debt, and that's a very small population. The same could be said of Statement 94, which may have a medium effort, but really only for governments that are involved in P3s. The third point is that some statements actually reduce financial statement preparation effort rather than add to it. For instance, in this list, Statement 93 and most of the provisions of Statement 99 should make the preparation of financial statements easier rather than a greater burden. And then fourth and last, the GASB almost always provides 2 to 3 years or more for the implementation of its statements, which is why these arrows are long and stretch over multiple years. It's very rare that GASB requires something be implemented in a shorter time frame, and if it does, it's either because it provides guidance that is needed by governments and their auditors immediately, or it is something that isn't going to require any real effort by governments to implement. So the next 2 slides are just for your benefit if you have instead a December 31st fiscal year end. The only differences in timing here are Statements 91 and 101 are 1 year earlier than the June through November fiscal year ends. And for the January through May fiscal year ends, because those fiscal years are ending later than they are for other governments, they also happen to be, for most of these statements, have an extra 6 months or so to the subsequent fiscal year. The only difference being they have the same implementation years for Statements 91 and 101, but all the other ones are 1 fiscal year later. Let's take a look now at the evolution. Maybe is an overstatement, but since I put the word in there, I have no one to blame but myself. If you're interested in finding GASB's technical plan, you go to GASB's website, gasb.org, and on their homepage, click on projects, and you will see a link that takes you to this page, or directly to the technical plan documents, so that you can see what GASB is planning to do over the next couple of years, the timelines for all of its projects, what's happened in those projects up to this point, and in particular, what the GASB is going to be doing over the next 4 months, because the technical plan is updated 3 times a year. If you looked almost a year and a half ago at the technical plan as of April 2022, GASB was getting very close to implementing 3 statements. The omnibus statement for 2022, which became Statement 99, the compensated absences, which are Statement 101, and prior period adjustments, which became Statement 100 on accounting changes and error corrections. And as GASB has been putting out those final statements, or put them out in the middle of 2022, it really hasn't replaced them with very much on its agenda. And you can see that the number of topics on the technical plan as of last month is considerably smaller than it was before. As we will discuss later, the scope of the reporting model project has been greatly narrowed, and really, I don't think really qualifies as a comprehensive project anymore. And the related recognition conceptual framework project has been dropped entirely. There's only one pre-agenda research activity, and it's not even a standard setting topic. It will be examining how GASB should publish its authoritative gap in the future. As you know, for all of its 39 years, GASB has published the original versions of its pronouncements and a codification of the currently applicable guidance from those standards, and both of those are authoritative. And then lastly, the scope of the infrastructure assets project, which is one of the only new projects that GASB has added in the last year and a half, in addition to subsequent events, which it just added last month. The scope of that infrastructure asset project is much narrower than the scope of the capital asset research that GASB created, which looked at conducted previously before adding the infrastructure project, which looked at all of the accounting and reporting guidance related to capital assets. And the board, based on that, on the research findings, decided to focus specifically on some issues related to infrastructure. Something else that you will notice is that in addition to there being fewer things in the technical plan, several of the continuing projects have had their schedules extended. The financial reporting model, even with the significant part of its scope that has been removed, and I'll leave that to Tina to talk about a little later, still had its final statement date extended by 4 months. The going concern severe financial stress project is scheduled for a final statement a year later than originally planned as of April 2022. The classification of non-financial assets project, which we'll talk about in a little bit, its final statement date is 4 months later than it was a year and a half ago. And risks and uncertainties disclosures, which is likely to be the next statement issued by GASB, was originally, as of April of 2022, supposed to be issued a year later in April of 2023. But now, if it continues toward issuance of a final statement, will happen in December of this year. And one other thing to note here, too, you see that little asterisk in the note below. In fact, GASB is not going to do an implementation guidance update for 2024 unless some new issues arise between now and next year that it wasn't aware of. But as of the voting of the board on this technical plan last month, the staff hadn't identified a sufficient number of questions to justify putting out an implementation guidance update next year. So you might ask, if the pace and quantity of standard setting projects has diminished, what's GASB been doing? Well, of course, they continue to devote considerable resources to supporting governments and auditors and other stakeholders in understanding and applying new statements. And they do so by answering technical inquiries, publishing implementation Q&As, speaking at conferences, and holding liaison meetings with stakeholder groups. This is probably a good time to remind you or to inform you for the first time that on GASB's website, there is a form that you can fill out to submit a technical question to the GASB, and they are really good at answering in an understandable manner and answering promptly. It's a great experience, and who better than to get answers from than likely the people who wrote the pronouncements that you're trying to implement. GASB is also conducting 5 post-implementation reviews on pensions, fair value, other post-employment benefits, fiduciary activities, and leases, in which they examine how governments are progressing with implementing the standards. They measure the cost and effort associated with implementation. They look to identify whether implementation issues are arising that need to be addressed through guidance or even amendment of the standards. And the first of those, pensions, which is the earliest of the standards in that group, is expected to discuss a draft final report with the board members and with their advisory group, the GASAC, in December of this year, which probably means they'll issue a final report sometime toward the second quarter of 2024. And then lastly, GASB has been closely monitoring developments in several areas that may ultimately require its attention, but they're not doing any standard setting in those areas. I want to emphasize that. So if you look at this and you see environmental, social, and governance reporting, GASB is not working on standards in that area. They did publish a really interesting white paper on their website that you can download for free that goes through all of the existing standards and points out that ESG is actually informed by a lot of current requirements that GASB has that aren't related to ESG, but talk to the same issues. It's not surprising that governments do a lot of things related to the environment and social issues and governance. Cryptocurrency is another area that they're monitoring, environmental credits, and electronic reporting. The latter there is something GASB is paying close attention to because of the Federal Financial Data Transparency Act, or FDTA, which was passed last December as part of the Defense Reauthorization Act. It requires the Securities and Exchange Commission and other federal regulators to establish data standards for submitting machine-readable data to them by December of next year, and then requires that governments and other entities that submit data to those regulatory agencies to adopt those data standards by December of 2026. I'm not going to get into this in any detail. It's a topic for an entirely different day, but there are 2 podcast episodes that are worth looking at if you want to hear more about what the FDTA is all about. There's one on CRI's website, cricpa.com. As Becky mentioned before, if you click on industries and government and public sector, that'll bring you to the government and public sector page on the website, and scroll down just a little bit and you'll see insights, which is a carousel full of all of those terrific resources that Becky was talking about, one of which is a link to that podcast. And GASB has started a podcast of its own, the first episode of which you can get to from their website, as well as I think from Apple Podcasts. And that first episode's topic is FDTA, in a conversation with GASB Chair Joel Black. One thing that I'd mention here, and the reason why I brought this up, is you don't see it in the technical plan, but GASB has been working behind the scenes to prepare if the SEC chooses it to be the entity that creates and maintains the taxonomy under these data standards, that they'll be ready to go as soon as they've been asked. It makes infinite sense for GASB to be the entity that the SEC chooses, since GASB establishes and maintains generally accepted accounting principles, and there's already a model for doing this. Because for some years now, the SEC has been contracting with the FASB, GASB's private sector sister, to maintain the taxonomy for the private sector for XBRL. And that brings us to our first poll question, Becky.
All right. I'm going to go ahead and launch the first polling question. Which of the following is not a GASB standard setting project? A, infrastructure assets. B, digital assets. C, classification of non-financial assets. Or D, subsequent events. Remember that you have to answer 80% of the poll questions in order to get credit. This will be up for the next minute and a little bit.
All right, and with that, I'll go over certain risk disclosures. Go on to the next slide, please. So what is the purpose of this statement? So stakeholders asked the GASB to address this issue, and ultimately they wanted it to kind of mimic what FASB had, which required disclosures of risk and uncertainties related to nature of operations, use of estimates, and certain concentrations. But when the GASB looked at this, they decided not to do that. And they believed there was guidance that needed to be examined in a governmental context. And with that, it's kind of where they came up with this statement. You can go to the next slide, please. So there's been a lot of talk around this statement and a lot of responses to its exposure draft. And because of that, the GASB responded and significantly reduced the complexity of this statement. And ultimately what they said is if a government is vulnerable to risks that are based on certain concentrations and constraints that limit its ability to acquire resources or control spending, that there needs to be disclosure. Now, this doesn't mean that there needs to be disclosure over concentrations and constraints. This means that if something with those concentrations and constraints is going to have a financial impact, that then there would need to be some disclosure. So for example, if you're in a small town and there is, let's say, a large retailer like Walmart that makes up the employment for 90% of the town and a significant portion of their sales tax revenue. Disclosing that it makes up the significant portion and that it employs most of the town isn't necessary with this disclosure. However, if it was understood that the store was going to close down and pull out of that small town, we now know that it's probably going to have a significant impact on their revenues. This is what this is relating to. This is the disclosure that this is aimed at disclosing. Can I go to the next slide, please? So when should a government apply this disclosure? So it's going to be, again, where there's a concentration or constraint that is known to the government prior to the date of the financial statements are available to be issued. This concentration or constraint, again, is going to make the government vulnerable to a substantial impact. So is there going to be a significant financial impact to the government because of this? And the event or events associated with this concentration that's going to create this impact has either occurred or is more likely than not to occur within 12 months of the date. So this big piece of more than likely or not to occur is something that they really trimmed down within this exposure draft. So when the first exposure draft came out, there was a lot of discussion because there was a lot over the likelihood criteria. And they have now shortened the time frame and made this just is more likely than not, rather than having such broad measurements over it. Let me go to the next slide, please. All right, so what's going to have to be disclosed? So for each concentration and constraint that meet all of those disclosure criteria, you're going to want to disclose information in sufficient detail to enable users to understand their nature and the government's vulnerability to the risk of the substantial impact. Now, this changes if the event has occurred. It's not just more than likely. If it's occurred, you're not only going to say the substantial impact, but you're also going to say what the actions are of the government in order to mitigate the substantial impact. Go to the next slide, please. All right. So one of the good things about this is that GASB recognized that some of these disclosures may overlap with other disclosures, such as our subsequent event disclosures. And it's okay, and the GASB said it's okay to address more than one of these statements in one disclosure. So it's not going to require separate disclosures for each of these. It'll be able to be all included in one disclosure if it crosses over the other. Let me go to the next, please. So this is kind of the time frame. So last week it was voted that this would kind of move forward. So it's on target to go ahead and proceed on December 2023. And it's expected to be effective for fiscal year ends for June 30th, 2025 and later. And with that, we'll go to another polling question.
Which of the following is a type of risk that a government might need to disclose? A, certain accounting estimates. B, certain liability measurements. C, certain concentrations. Or D, certain court judgments. Remember, you need to answer 80% of the polling questions. If you can't see your poll question currently, please make sure that you haven't minimized your polling question screen. And also, we will not be discussing the answers to the polling questions today due to time constraints. We have a lot of content for you, and we want to make sure that we get to all of this content.
Thank you, Becky. I will mention for anybody interested, the poll question, the first one, the answer was, I think digital assets is not one of the standard setting projects. That's a monitoring project. So Tina just talked about what is likely to be the next GASB statement. At the same meeting last week, talk about up-to-the-minute updates here. The GASB members voted to issue an exposure draft of a proposed statement in its classification of non-financial assets project, the title of which will be Disclosure and Classification of Certain Capital Assets. So this is going to come as a shock to some of you, but generally accepted accounting principles are not perfect. They're not pristine. They do have some inherent issues. GASB, I think, does a great job working to maintain consistent standards over time. And especially considering that they've been doing this for 39 years with 33 different board members and turnover in the staff during that time and lots of changes in the government environment. It's a wonder there aren't more internal inconsistencies. But one of them that this project deals with, was highlighted by the requirement to recognize intangible right to use assets in statements 87 on leases, 94 on P3s, and 96 on subitas. It brought to the fore the fact that there is some inconsistency in GAAP in the way that non-financial assets are defined, and intangible assets, capital assets are all types of non-financial assets. And so this project was intending to try and sort that out and to identify what types of information users needed to see below the umbrella of non-financial assets, either on the face of the financial statements in the notes. And it's worth mentioning that this project has always been limited just to display or disclosure classification in general, and hasn't tried to take on issues of recognition or measurement related to those non-financial assets. The project started with a lot of issues, a lot of different types of non-financial assets, but as you will see, what they've proposed is dealing with a much narrower set of issues. Specifically, the exposure draft, which should be available in the next week or so on GASB's website. They just need to do some publication work on it to make it look all spiffy, and then you'll be able to download it for free. The GASB is proposing that the following should be disclosed separately in notes to financial statements: capital assets that are held for sale by major class of assets, lease assets by major class of assets, subscription assets, and other intangible assets. They also are proposing that intangible assets that represent the right to use intangible underlying assets, other than those that are reported as subscription assets under Statement 96, should be classified together with owned intangible assets rather than as their own category. So that would be different from what is being proposed here, that lease assets that a government is leasing as the lessee, should be shown separately from assets, capital assets that the government owns. Because this proposal would require that capital assets held for sale be shown separately for the first time, the proposal also provides guidance that doesn't exist right now to help identify capital assets that qualify as held for sale. It basically are two criteria. One, the government has decided to sell the asset, and two, it's probable that the sale will be finalized within 1 year of the financial statement date. The exposure draft proposes that the factors to be considered when evaluating whether it's probable that the sale will be finalized include whether the asset is available for immediate sale in its present condition, whether an active program to locate the buyer has been initiated, the market conditions for selling that type of asset, and any regulatory approvals that may be needed to sell the asset. And then lastly, the exposure draft proposes that classification as held for sale should be evaluated for each reporting period when financial statements are prepared. The comment period actually is going to extend to January 5th. I guess GASB realizes that not everybody spends their December holidays reading GASB proposed statements and writing comment letters. So you do have a little bit of leeway. So it's a little bit more than the standard 90-day comment period. Redeliberations are expected to start in March of next year. And the technical plan expects that the GASB will consider issuance of a final statement in July of 2024, and they've proposed an effective date of fiscal years ending June 30th, 2025, and all reporting periods thereafter. The biggest remaining, sorry, that's okay. I jumped ahead of myself, Tina. My apologies.
No, we're good. So the financial reporting model, I know it's because we were like tug of war on who wanted to present this one. And I think this one I won on because I was super excited about presenting financial reporting model project. And we get to the next slide. So in June, the GASB decided, as Dean alluded to earlier, to remove the provisions related to governmental fund financial statements from this project, and also the companion conceptual framework project on recognition was also dropped. So the scope of this project has gone to a very, very narrow basis, which is great news to a lot of us practitioners. And I know some of you, like Dean, that worked on this isn't as happy, but I know a lot of us within the governmental sector are very happy about it. And much of the reason they did this is for cost-cutting purposes. I mean, they just knew that although it may be needed, that there be more clarity along the measurement focus basis of accounting, it would result in a lot of costs, or it was perceived costs that would be incurred. And they said that maybe they needed to put a pause on this because of that. And I think that was a great decision. And I think a lot of people in the governmental sector will agree with that, because nobody wanted to incur the cost of having to redo all the financial statements. So I think this is a great news to a lot of people, and I was glad to be able to be the one to share it. Can we go to the next slide, please? So the topics remaining in this project really aren't that robust. It's really MD&A, presentation of proprietary fund statements of revenue, expense, and changes in fund net position, major component unit financial statements, unusual and infrequent items, operating, non-operating revenues and expenses, budgetary comparison information, and the statistical section. But it's really going to be more of a tweaking of all this. So I think that, again, this was pretty exciting news for a lot of those in the government sector, that they really narrowed this and that they kind of dropped off on the other stuff as well. Let me get to the next slide. So this is supposed to conclude deliberations in the September-December timeframe. So I guess closer probably to December at this point. And then they're going to review a pre-ballot in 2024 and get the final in 2024. But it would be effective for June 30, 2026 and after. With that, we'll get our next polling question.
All right, polling question number 3. Which of the following is not a proposed factor to consider when evaluating whether it is probable that an asset sale will be finalized within 1 year of the financial statement date? A, whether the asset is available for immediate sale in its present condition. B, market conditions for selling that type of asset. C, regulatory approvals needed to sell the asset. Or D, whether the asset relates to governmental activities or business type activities. Just a reminder, you do not have to get the answer correct in order to receive credit for the polling question, but you do need to answer 80%. And we will leave this polling question up while we continue our presentation. Dean or Tina, I think you're muted.
I was gonna say the same thing, Dean. I think this is you.
Sorry, you're right, it was me. So I believe the things that I said while I was muted were that the answer to the last polling question number 2 was certain concentrations. And then made a point of saying that this is really the last big project left on the agenda. This and the financial reporting model are identified as comprehensive projects that deal with major aspects of the fundamentals of GAAP. Now that, as Tina said, that the governmental funds part of that project has been removed, it's probably really not a comprehensive project anymore, maybe a major project. Revenue and expense recognition, however, continues to be a comprehensive project. It started about 7 years ago, maybe more than 7 years ago, in 2016, and it primarily is addressing the existing standards for non-exchange transactions in Statement 33, which were issued 25 years ago, a little over 25 years ago, and have been in effect for more than 20 years now. A post-implementation review that was conducted of Statement 33 found that it was largely working well in practice, although it's a fairly difficult standard to understand. But that there were some issues that had developed in practice that required some attention, especially difficulties that governments had in differentiating between exchange-like, and non-exchange transactions. One goal of this project is to produce a comprehensive set of guidance for revenue and expense recognition. And if you look at what is in current GAAP for exchange transactions, there's very, very little there. There's nothing like the degree of guidance that's in Statement 33. So there are several paragraphs related to exchange revenues and maybe one paragraph related to exchange expenses. So this project is hoping to provide guidance that doesn't exist for what tend to be most of the expense side transactions for governments and a lot of the revenue side transactions as well, particularly if you're a government that's a business type activity that largely depends upon charges to customers. Exchange revenues is a big deal for you, and there really isn't very much guidance on how to account for them. There have been 2 due process documents in this project so far. There was an invitation to comment issued for public discussion in January of 2018, followed up by a preliminary views over 2 years ago now, over 3 years ago now, sorry, in June of 2020. It had a very lengthy comment period, in part because of the pandemic, but by May of 2021, GASB had started to redeliberate that. So that's almost 2.5 years ago, and they're only have redeliberated a portion of what was proposed in that preliminary views. So they really are not in any hurry with this project. And I think when we get to the final slide on this topic, you'll see that an exposure draft is still some ways out. In terms of the things that have been redeliberated in light of the comments that GASB got from governments and auditors and other stakeholders, the first thing was the board confirmed the overall components of a recognition model: categorization, recognition, and measurement. Categorization is determining what type of transaction you're dealing with, which is important because the type of transaction dictates the guidance that is followed for recognition. So under current standards, categorization involves that thing that I just mentioned is a real problem for a lot of governments, which is distinguishing between exchange, exchange-like, and non-exchange. And as you know, the standards for non-exchange versus exchange are very, very different. Recognition then are the rules that say what should be reported in the financial statements in terms of assets, liabilities, revenues, expenses, and so on, and when they should be reported in the financial statements relative to the occurrence of the transaction or event. And then lastly, measurement determining for those things that should be reported in the financial statements, how much they should be reported for in the financial statements. If you remember what was proposed for the decision tree for classifying or categorizing transactions in the preliminary views, it was a lot more involved than what the board has tentatively settled on in redeliberations. There were multiple steps, and it included a lot of conceptual language that I think made the proposal seem more complex than it really was. But GASB has stripped it down and simplified it somewhat to drive toward what it called in the preliminary views, either a Category A transaction or a Category B transaction. GASB deliberately used nondescript titles for them so that labeling them or giving them specific titles they were worried would bias the responses in one direction or another. So they wanted them to be evaluated on their provisions individually and not based upon the name that GASB chose for them. But based upon the tentative decisions the board has made since then, I think effectively you can say that a Category A transaction is one that includes a performance obligation, and a Category B transaction is one that does not. So the next step after laying out that procedure was to begin to put some flesh on the bones with respect to how revenue recognition and expense recognition should occur. With respect to revenue recognition, the starting place is either a receivable or consideration that is received before a receivable arises. And in that case, a liability should be recognized for that consideration received in advance of an enforceable legal claim that constitutes a receivable. And if the inflow is applicable to a future reporting period, a deferred inflow should be reported. If this sounds vaguely familiar, it's because that's essentially what's required right now. And the expense recognition methodology that the board has tentatively agreed to is the mirror image of the revenue recognition methodology, with the focus being, of course, on payables and prepaid assets and deferred outflows rather than receivables, liabilities, and deferred inflows. I apologize that if you now see that this slide in your slide deck, which comes next, I've moved up because it really belongs here, and I apologize for that. This is essentially just a visual representation of what we just saw on the prior slide, so I'm not going to belabor it, but I think it helps it to understand the decision process in that recognition methodology. This is what you would have seen as the next slide in your handouts. GASB hasn't redeliberated this yet, but just to give you a sense of with Category A transactions having performance obligations in them and revenue and expense recognition being predicated on the fulfillment of that performance obligation, what it is that is in Category B. And as I said, GASB hasn't re-examined this yet. This is what was proposed in the preliminary views, but it does at least give you a sense of where they're going. The first two categories here of Category B transactions, derived revenue and imposed revenue, are exactly the same as imposed and derived non-exchange transactions in Statement 33. But then the remainder of the non-exchange transactions in Statement 33 under the umbrellas of mandatory non-exchange and voluntary non-exchange are broken out into three groups, in part to provide more specific guidance on how to account for and recognize assets and revenues and expenses and liabilities related to these transactions, but also to address some of the issues that have arisen in practice for governments that have had difficulty figuring out where certain transactions fit, whether they belong in mandatory or voluntary non-exchange transactions. And part of the reason for that is that some of these transactions really do require a different approach to recognition, not vastly different, but not precisely the same. So there are three groups here: contractual binding arrangement, which is things like donations and pledges and purpose restricted grants, general aid to governments like state formula aid to school districts, and then lastly, shared revenue, for instance, states that share a proportion of their sales tax with local governments. As I mentioned before, this project has been going on for a long time, and it will continue to go on for a long time. An exposure draft is not expected to be considered for issuance for another 2.5 years. Is that right? 2.5 or 1.5 years in March of 2025. And then a final statement is targeted for June of 2027. And obviously, there'll be several years of implementation for something this fundamental. I would say at least 3, maybe 4 years if I were a betting man. So if you are planning on retiring anytime in the next 6 or 7 or 8 years, you probably will be able to entirely avoid the implementation of whatever statement comes out of this project. And that brings us to our next polling question, Becky.
All right, polling question number 4. Which of the following is not a component of a revenue or expense recognition model? A, allocation, B, categorization, C, recognition, or D, measurement? We'll leave the polling question open for the next 1.5 minutes. Remember, you don't have to get the answer correctly, but you do need to answer.
And as an FYI to everybody, the answer to polling question 3 was, I think it was D, whether the asset is related to governmental activities or business type activities. That's not relevant to determining whether a capital asset is held for sale. After revenue and expense recognition, probably the biggest project on the technical plan at this point is going concern uncertainties and severe financial stress. The ball got rolling on this project several years ago, maybe 7 or 8 years ago now, when the AICPA came to the GASB and raised concerns about the relevance of going concern guidance to state and local governments. GASB responded to that by conducting what ended up being more than 6 years worth of pre-agenda research. And some of the findings from that research, I think, supported that notion that as written in existing standards, going concern doesn't seem to really make a good fit with state and local governments. For instance, the research found fewer than 300 going concern opinions were given to state and local governments over nearly 20 years. And in a lot of cases, multiple going concern opinions were given to the same government, which means there might have been 300 going concern opinions over those 20 years, but maybe was half that number of governments that they were given to. And between 2002 and 2012, only about 130 general purpose governments ceased operation. About 70% of them dissolved completely, and GASB found that smaller governments were more likely to dissolve completely than larger governments, which were more likely to be part of a merger or an acquisition than a complete elimination of the entity. So what this project is trying to address based upon the research findings is essentially 2 things. One, to improve upon the existing going concern standards, because there still are instances in which governments may still cease operations, particularly when you're talking about special purpose governments rather than general purpose governments. And then the other part of the project is seeking to determine if guidance can be developed for an earlier signal to users before you're even talking about possible dissolution or any signal at all, since so few governments ever face dissolution, that will let the user of the financial statements know that there are some serious financial issues here. And that's the part that is focusing on severe financial stress. I am not going to read the existing definition of going concern, but we wanted to provide it in a slide here for your reference. I would say that the key parts of this existing definition of going concern that limits its effectiveness in the state and local government environment include the assumption that a government will continue as a legally separate entity and the emphasis on financial problems, even though the GASB research found that dissolutions rarely occur, and when they do, it's rarely because of financial problems. It's more often because they are seeking greater efficiency or because of low citizen participation in the existing entity. Almost all of the deliberations the board has had so far have related to going concern uncertainties. So among the tentative decisions the board has made is to define going concern, and the place they started was to say that the guidance for going concern uncertainty should focus on uncertainty about a government's existence, regardless of its financial condition, because the financial focus strictly may have been appropriate for companies, but is really too narrow for governments based upon what the research shows are the reasons why governments cease to exist. The GASB has also tentatively decided that going concern uncertainty guidance should be applied to all forms of government dissolution, not just complete elimination, but also mergers and acquisitions, and then have tentatively defined going concern as the assumption that a governmental entity will continue to exist as the same legally separate entity, regardless of its financial condition. Cease to be a going concern tentatively means that a government ceases to exist as the same legally separate entity due to merger, acquisition, or dissolution without replacement. And then uncertainty about going concern is substantial doubt about whether a governmental entity will continue to exist as the same legally separate entity. GASB has tentatively decided to propose that a government should evaluate all relevant factors that indicate a likelihood of a potential government dissolution and determine whether all relevant factors considered in the aggregate indicate that a going concern uncertainty exists. Tentatively, GASB has decided that there are two types of factors that should be separately identified from all other relevant factors. The first is a dissolution triggering event, which is the initiation of dissolution legal proceedings. Could be by the citizenry or the state government or by the government itself based upon regulations or laws. And the second is that factors that may either increase or decrease the likelihood that a dissolution triggering event would ultimately result in a dissolution. Continuing with the board's tentative decisions related to going concern uncertainties, the board plans to propose that the management's mitigating plans should be considered relevant factors for assessing and identifying going concern uncertainty. And the length of time horizon for going concern uncertainty should be 12 months from the date the financial statements are available to be issued, which is a departure from the existing guidance in Statement 56, which is 12 months from the financial statement date or shortly thereafter. But this guidance, this tentative language would be more in line with the language that FASB standards use. And then lastly, relevant factors to identify going concern uncertainty should be known and reasonably knowable to the government at the date the financial statements are available to be issued. And that phrase, known and reasonably knowable, GASB has settled on a tentative definition for it. GASB has only just started to deliberate the issues related to severe financial stress. I think maybe 2 meetings so far. And so there aren't that many tentative decisions yet. One is that any guidance in this area should focus on a government's financial condition, regardless of whether there is uncertainty about continued existence. So in that way, it would fit very neatly with the tentative definition of going concern uncertainty, which relates to whether the government's legally separate entity is going to continue to exist regardless of its financial condition. Second, severe financial stress is a range of conditions defined as when the government either is in the circumstances or has had to take extraordinary measures to avoid being in those circumstances. And then lastly, severe should be defined as a degree greater than substantial, including but not limited to catastrophic matters. So there's a lot of work left to be done on severe financial stress, and GASB is looking at about another 15 months worth of deliberations before issuing its first due process document for public comment in this project, which is tentatively scheduled for December of 2024 and would be a preliminary views. Major projects like this almost always have two due process documents, a preliminary views, and then an exposure draft, which would be tentatively scheduled for June of 2026, with a final statement targeted for consideration in June of 2027.
All right, I think we're going to come up and touch on some implementation guidance update for 2023. Go to the next slide. So just to give a little history on these implementation guides, the first one in 2015 resulted from a re-examination of all the existing implementation Q&As. And that, in conjunction with GASB Statement 76, raised them to a Category B authoritative GAP. So pretty much this is a higher level of authority, is these implementation guides. So in all but 1 year since then, GASB's issued implementation guidance. And this year they went ahead and issued another one. It was cleared by the board in June of 2023, and it's effective for all fiscal years beginning after June 15th, 2023. Can we get the next slide, please? So what does this new implementation guide cover? Well, it covers short-term leases, lease term, lessee recognition, lessor, a lot on leases. And then we have some on civitas and then accounting changes. But I think you'll see it's primarily related to leases and civitas. So the first one, I don't want to go in too much detail of reading the questions and getting through, but the first one is pretty much related to lease term and maximum lease term. So what it's saying is the question was, a lease contract states that it'll remain in effect for 3 years unless terminated before then. Then the contract allows for the lessee to terminate for any reason in 60 days and the lessor to terminate within 60 days if the lessee defaults on payment. So the question is this a short-term lease? And the answer becomes no. The lessee has an unconditional right to terminate and therefore has an option to terminate. So we can go to the next slide. I'm kind of going to go through a little bit more detail. So differentiating maximum possible lease term from lease term is what's, I think, getting people confused at this point. So I think understanding what the two things are, maybe will make it easier to understand. So the sole purpose of determining maximum possible lease term is to evaluate whether a lease is short term or not. So does it need to be recognized under the lease standard? Once that is determined by the maximum possible lease term, the lease term is evaluated only to measure the lease liability if the maximum possible lease term is greater than 12 months. So you have to know the maximum possible lease term to say, do we even implement this standard? And if so, what is the lease term from there? So it's two separate things. The maximum possible lease term includes the non-cancelable period and any options to extend, regardless of the likelihood. So it doesn't matter about likelihood. It's what's the non-cancelable period and are there any options to extend? And that's going to be your maximum possible lease term. On the other hand, the lease term includes an option to extend only if it's reasonably certain to be exercised. So if we don't think it's going to be exercised for the lease term, then that's not included because that is what's determining that lease liability. This guidance not only can be applicable to leases, but also can be applicable to a good bit of civitas as well. If we could go to the next slide, please. All right, so again on leases, and you'll see that the first, 3 questions we're going to go through have to do with short-term leases. Is this a lease that has a non-cancelable period of 36 months. And the lessee has an option to extend the lease for an additional 12 months. At the end of the commencement of the lease, it is not reasonably certain that the lessee will exercise that option. At the end of the non-cancelable period, the lessee exercises that option to extend the lease. Does exercising the option to extend the lease result in the maximum possible lease term? So again, we're talking about this maximum possible lease term and if there's changes to it or can there be changes to it? And the answer is no. The maximum possible lease term, again, includes the non-cancelable period and options to extend regardless of likelihood. That likelihood, once again, comes into play when we're looking at the lease term, not the maximum possible lease term. Can you go to the next slide, please? The government's judgment of that likelihood of the option being exercised is not relevant to the determination of the maximum possible term. So that 12-month extension is included in that maximum possible lease term regardless of anything. The decision to exercise the option, add 12 months to the lease term, does not result in the remainder of the lease becoming short term. So when you originally determined that the maximum possible lease term was for 48 months, that's going to stay unchanged. A lessee would recognize a lease liability for the present value of that remaining 12 months, but it wouldn't change your maximum possible lease term. A lessor would recognize a lease receivable for the present value of the payments to be received during the rest of that 12-month lease term and a deferred inflow of resources. So the guidance in this Q&A also can be applied to subitas, which would follow the same provisions in paragraph 13 of Statement 96. Can we go to the next slide, please? All right, so again, on the short-term leases again, and this one really has to do with changing a long-term lease to a short-term lease once you've made that determination. So in what circumstance does a lease modification result in a short lease? And there's really a short-term lease, and it's really only 2 times. And that's if the lease was already a short-term lease before the modification and the maximum possible term after the modification still kept it in 12 months or less, then it stays a short-term lease. And then regardless of whether it's a short-term or long-term lease, if the modification meets the criteria of paragraph 72 in Statement 87, then it's possible that there could be a separate lease for less than 12 months. And if we go to the next slide, we'll kind of go over that in more detail. So paragraph 72 identifies the conditions under which a lease modification should be accounted for as a separate lease. So if the lessee is given an additional underlying asset not included in this original lease, and then the lease payments appear to be reasonable, the increase in it for that underlying asset, it becomes like a second lease to the lease. And that can be looked at as a short-term portion. Short of accounting for a new lease, once it's determined that an existing lease is not short-term, the only circumstances under which it can be subsequently treated as short-term would be if prior to the end of the 12 months of the lease term, the lease is modified to be shortened to less than 12 months. So if you have something that you expected to be long-term and it got shortened to less than 12 months and you were still within that first 12-month period, that's pretty much the only time you would see this. And again, this can be comparable with subitas as well when looking at paragraph 13 and 54 of Statement 96. And here's our next polling question.
All right, polling question number 5. Which of the following is not an issue with the existing standards for going concern uncertainties? A, governments rarely cease to exist. B, going concern opinions are very infrequent for governments. C, the guidance is old and has never been reviewed in a government context. Or D, they are hard to find on GASB's website. Now, we said that GASB spent over 6 years conducting research before adding this project. What took so long?
I think the biggest part of it, Becky, was the looking at severe financial stress. The GASB not only had several studies done with respect to the existing standards, and that's where those factoids about the infrequency of going concern and of dissolutions of general purpose governments came from. But they also hired a couple of sets of academics to analyze what ended up being something like 220,000 or 230,000 data points that GASB staff collected from about 500 governments of different sizes and types over a 5-year period to see if they could identify some key data points or key measures that were universally accepted as warning signs of severe financial stress. And what came out of that, I think in a nutshell, and it's hard to summarize that many years of research, but the severe financial stress side is clearly very, very important to users. And they want something that is going to give them a heads up about financial difficulty long before you're ever talking about bankruptcy or dissolution. But the data or measures that they tend to focus on are very disparate, and not everybody agrees on them. You can categorize them, I think, into the same 5 or 6 types of information or measures, but the specific measures that are being used vary considerably. And so I think that means that whatever GASB does in this project isn't going to be some equation that governments can plug their own numbers into that will end up saying you're exposed to severe financial stress. I think chances are they will end up, if they provide any guidance at all, with something similar to a list of important factors to consider when evaluating whether a government's exposed to severe financial stress. Much in the same way, there's a set of factors to consider for assessing whether there's uncertainty about them being a going concern. And for anyone who's interested, the answer to polling question number 4 was allocation. And is this one still open, Becky, or can I give the answer to number 5 as well?
Go ahead and give the answer, Dean.
The answer is D. They're not hard to find on GASB's website. They're very easy to find. That's not something that was relevant for deciding to go back and look at the going concern standards.
I pulled a you, Dean. I was muted and talking.
That I think everybody listening is probably used to hearing that at least once in every webinar.
Absolutely. All right, we'll go on to the next one, which is question 4.4, which is lessees. So this one has to do with the accrual of interest expense on prepayment or deferred payments. And I think this is a good one to talk about as well, which is a government leases a building and the lease term is for 10 years. At the commencement of the lease, the government provides the first 3 payments and recognizes a liability for the present value of the remaining 7 payments, which will be paid starting in the 4th year of the lease. Should the government recognize interest expense during each of the first 3 years of the lease? And the answer on this is yes. In accordance with paragraph 24 of 87, interest expense represents the amortization of the discount on the lease liability. So the discount should be amortized over the entire lease term, including each of the first 3 years from which the government's not making payments. So the interest liability will continue to accrue until the government starts making payments in the 4th year. And we go to the next slide. This really is a build upon question, right? So in 12.21.1, there was a scenario in which the entire contract was paid in full at the start of lease term. And at this point, there would have been no interest expense reported because there was no liability. But this one's a little bit different. This one, there's an upfront payment for the first 3 years. So the government's recognizing a liability for the remaining 4 to 10 years. So although no payments were made in years 1 to 3, interest was still accruing on the remaining portion that was still due for year 4 through. So that's kind of how there's a difference in the two. And again, this guidance can also be utilized in SEBITAs with paragraph 19 and statement 96, and also in PPPs in paragraph 43 and statement 94. All right, so this one is dealing with lessees and the exchange rate fluxes, because I think a lot of people are getting confused, and not only do I, but this is what this is addressing with the index or a change in rate as opposed to different things. So this one has to do with a public university that entered into a lease of a building in Europe, and how it would account for the exchange rate, and that are lease payments considered variable payments because they depend on an index or rate, because that US dollar is going to be subject to change with the exchange rates. And when the GASB responded to this, they said no, because the currency in which lease payments are made doesn't affect those payments being considered fixed. So that isn't going to be a difference as opposed to if there was an index or a rate change. So if we could go to the next one. So again, there's kind of confusion over index or rate. So, sorry, index or rate, and payments based on an index or rate, and changes in an index or rate. So the prior one where we're looking at this and we're saying, hey, there's a change in the exchange rate because we're looking at euros to cash, that really falls under GASB 62 in how to deal with the foreign exchange rate. But this is different. By their nature, an index or rate amount, likely it changes from period to period. That is different from the index or rate itself being changed. In that saying, so the index or rate we were using is now changed. If you're substituting a new index or rate, then that's going to consider it being a modification. So it's a difference. And again, it can be analogized by SEBITAs and PPPs as well, but this would probably be very rare. And this is obviously going to be a rare instance, because again, that exchange rate really isn't the same thing as an index or rate change, because the exchange rate really falls under GASB 62. Can we go to the next one, please? It's another polling question.
All right, polling question number 6. Which of the following does the GASB not do to support stakeholders in the implementation of its standards? A, review draft financial statements. B, publish implementation Q&As. C, respond to technical inquiries. Or D, make presentations at stakeholder organization conferences.
All right, so now we've talked about short-term leases, lessees, and we're going on to the lessor. And I think with this one, I thought this was pretty interesting, because I think this is a topic that I've heard a lot in this lease implementation guidance, which is, you know, if paragraph 54 of statement 87 requires that the deferred inflow of resources related to a lease be recognized as inflows of resources over the lease term. If reported as revenue, should a business type activity or enterprise fund report those those inflows of resources as operating revenues. So I find this one kind of funny, because I think that it's kind of one of those that answers, it depends. And it does depend. So if we go to the next slide, please. So with the absence of definitions of operating, non-operating GASB standard, it makes classifying business type activity and priority fund revenues and expenses kind of challenging. And it really goes down to the policy of that government, right? So what is the policy of that business type activity or those priority funds in recognizing their revenue? So for instance, if their main source of revenue is from lending, then it would become operating, or if their main source of revenue is from leasing, I should say, that asset, then obviously it's going to become operating. But if it is not, then it's not going to be operating. So I think it really depends, again, on the operations of that government, the policy of that government, and how that income is in relation to that government. Is it an operating income or not? Is it some of their primary operations that go into that? Is leasing their primary activity that they do within that government? And that's where we go to. So you'd have to go to Q7 73.4, or you could also get additional information in Q7 73.1 as well. So again, still on leases. This one is, I'm sorry, this is a revision to our prior question that dealt with the lessor's option to terminate. So a lease contract allows only the lessee to unilaterally terminate the lease at any time, but also provides for cancellation penalties. The cancellation penalties are so great that it's reasonably certain that the lessee will not terminate the lease. Prior, it said, should the cancelable periods be excluded from the lease term? Now it's been updated to say, should the periods covered by the lessee's option to terminate be excluded from the lease term? And the answer is no. Paragraph 12 of Statement 87 required that the periods covered by either a lessee or a lessor option to terminate the lease be included in the lease term if it is not reasonably certain that the lessee or lessor will not exercise the option. So all this really did is just update the language to a prior question from cancelable to covered by the lessee's option to terminate. Let me go to the next thing. The substance of this Q&A really hasn't changed. It's only the original wording has changed a little bit in order for it to be in line with the statement. We go to the next. Thank you. So now on to subitas. I know this is one of Dean's favorite topics. Anytime he wants to jump in, I'm happy for him to jump in. And this one is a licensing agreement for a vendor's computer software that automatically renews until canceled a license agreement that provides a perpetual license? And the answer is no. And I really think it goes up to this auto renewal piece. And if we kind of go to the next slide. Auto renewals are common in a lot of the subitas. So if an arrangement can be extended or terminated, it's not considered a perpetual license, which constitutes a purchase software. Whereas subitas is a leasing of that software. Because auto renewals require no action on the party to extend the subita, the GASB observes that they effectively are options to terminate. So periods in which both parties have the option to terminate are excluded from the subscription term and the maximum potential term. So consequently, any subita with an initial non-cancelable period of 12 months or less and auto renewals beginning at the end of that period would be considered short term. So those auto renewals are not going to turn it into this perpetual nature. It's just not considered not part of the non-cancelable. If the initial non-cancel period is greater than 12 months, the subscription term is limited to just that non-cancelable period. Again, this can be analogized to leases and to PPPs, but the auto renewals aren't normally common in leases and PPPs either. All right. So another one on subitas. For the purpose of determining the applicability of Statement 96 to software as a service, platform as a service, and infrastructure as a service contain a combination of IT software and tangible capital assets. And the answer is yes. Software as a service, platform as a service, and infrastructure as a service are three common deployment models of cloud computing arrangements. So in doing this, you would have to look at Statement 96, paragraph 6, to determine if it meets the definition of a subita. If we go to the next one, slide, please. So what an arrangement is called may or not be relevant to the evaluation of whether a transaction meets the definition of a subita. So I think we've seen this a lot in the implementation of 87. So I think it is a lot of transactions, they may call themselves a lease, but when you look at it, it's not really a lease. So something may appear to be a SBITA, but when you're looking at paragraph 6 and you're looking at, hey, is this really the definition of a SBITA? We need to go through this. So when you're looking, is it yes, it's a subscription as a service. Yes, it's a platform as a service. Yes, it's infrastructure as a service. But is it really fall into the definition of a SBITA? And we need to be careful with that, because I think sometimes what people call something and what it actually is per the definition, the standard, can be two separate things. And this is pretty much what this question is addressing, is that we need to be cautious in looking at the definitions and making sure that it applies to the definition of a SBITA per paragraph 6. But I also would caution to do the same thing when looking at leases, when you're looking at statement 87 as well. All right, subscription term. So government enters into a 6-year SBITA contract with no options to extend or terminate the contract, and begins making semi-annual subscription payments to the SBITA vendor immediately after the contract takes effect. The initial implementation stage is not completed until the end of the 2nd year after the contract takes effect. What is the subscription term? So I think we're going to see this in a lot of these SBITAs, because a lot of these SBITAs have where they need to be installed or have implementation time, and it may take the more complex the program a longer period to be installed. So in accordance with paragraphs 9 and 15 of 96, the subscription term doesn't start until the actual subscription commences. So it wouldn't have started in this one until year 3. So you would really only have a subscription term of 4 years. If we go to the next slide, please. So SBITAs that involve software that is customized and not off the shelf and just, put in, normally you're going to require some of that time, as I was saying before, to be installed and made operational. So subscription assets resulting from the SBITAs may not be placed in service for multiple years after the work commences. So once it's put in place and it can be utilized and the subscription starts, that's when that subscription term actually starts. The point at which the subscription asset is placed into service kind of triggers that. Can we go to the next one, please? All right, kind of one of the final and last implementation guides. So this one has to do with accounting changes. And I know that I've heard a lot of chatter about this, and there were a lot of questions. On sitting on the state and local government panel, I know we had a lot of conversation over this when the exposure draft first came out. So I think this is a really good question that came up and being responded to by the GASB. So upon completion of a capital project during the year, a government closes out a major capital projects fund and moves the remaining resources to the general fund. Does this circumstance constitute a change to or within the financial reporting entity? And the answer is no. Even though the capital projects fund will no longer be included in the governmental's financial reports in the future periods, that doesn't constitute a change to the financial reporting entity in accordance with paragraph 9A of Statement 100. Because in this case, the removal of the fund does not result in movement of continuing operations. It's kind of like that capital project was over, that's when it got moved. So it's really when it's the movement of operations is what's really going to trigger that accounting change. Can we get to your next? Thank you. Routine opening and closing of funds is not what GASB intends to capture with paragraph 9A. What they intend to capture is when there's an actual financial reporting change. So for example, if a government has a utility fund that they've recognized as an enterprise fund for years, and all of a sudden decides that they're not going to recognize it that way anymore, and now we're going to report it as a special revenue fund, that's a big change in financial reporting. That's what it's talking about. The closing of the enterprise and creation of a special revenue fund would constitute that accounting change as defined in paragraph 9. So it's really looking for more as a change in accounting rather than just routine opening, closing of funds, which is the normal operations of the government. All right, on to another polling question.
Polling question number 7. Which of the following statements is not based on a common accounting and financial reporting approach? A, Statement 87 on leases, B, Statement 94 on PPPs, that's private-public partnerships, C, Statement 96 on SABITAs, or D, Statement 101 on compensated absences. And Dean, we already discussed the answer to the last polling question, right?
Yes. So when we get to the next polling question, I'll let everybody know what the answer to this one is.
Perfect.
So the last topic we're going to talk about today, I think Tina leads into really well with discussing those three SABITA-related questions in the implementation guidance update from June of this year. Governments either are applying Statement 96 right now, or they're in the fiscal year to which Statement 96 will first be applied and should be working toward implementation of Statement 96. Particularly important because just like Statement 87, the implementation of Statement 96 requires measuring the liability and asset as of the first day of the fiscal year for which the government is implementing the statement, just like we did for leases under Statement 87. And it's much easier to do that if you don't wait until the fiscal year is over. Right from the start, a challenging task, as it was with leases in Statement 87, is identifying contracts that constitute a SABITA. Compared with leases, though, SABITAs may be more challenging because they tend to be more numerous than leases, more likely to have been entered into by various departments across a government, which makes coordination harder and the process of collecting the information more difficult. They may be smaller in dollar amount individually, and they may be less well documented than leases. One of the key exceptions or exclusions from the scope of Statement 96 has to do with arrangements that have components related to both IT software and IT hardware. And Statement 96 says that such transactions, such contracts should be accounted for under Statement 87 rather than 96 if the combination of IT software and hardware meets the definition of a lease and the software component is insignificant compared to the cost of the hardware. And two examples are cited in Statement 96: computers with operating systems and smart copiers connected to an IT system. So professional judgment is going to be really important here to evaluate this concept of significance of the software in relation to the cost of the hardware. And I would emphasize that that evaluation may involve qualitative factors related to the significance of the software component and not just a quantitative comparison of the software and the hardware. It turns out that something else that really can directly affect the evaluation of the maximum possible term of a SABITA is whether options in the SABITA involve extending the existing contract or entering into new contracts. And there are a couple of questions in the comprehensive implementation guide, they're cited at the bottom of this slide, that we've come up with a couple of examples based on. So let's say a school district enters into a 12-month contract that states that the district can renew, and the district decides to renew, but when it does, it has to enter into a separate contract with the other party at a later date for the subsequent 12-month period. And the question is this existing 12-month contract a short-term lease or SABITA? In this case, we're talking about the context as a SABITA, and the answer is yes, because the maximum possible term under the contract is 12 months or less. The district has to enter into a new contract. It can't extend the existing contract, and the existing contract only covers 12 months. If we mix it up a little bit, let's say a school district enters into a 12-month contract with no options to extend, and the vendor has signed a new contract every year for the past 20 years, so the district expects they're going to continue to do so. Is this a short-term subpoena? And the answer again is yes, because the history or future likelihood of signing new contracts aren't relevant to determining the maximum possible term. If this contract could be extended rather than requiring entry into a new contract, and there was some information that informed the likelihood of of the contract being extended by the vendor, then that could very well be relevant to evaluating whether any additional term should be included in the maximum possible term. Tina dealt with a question in the implementation guidance update for 2023 related to automatic renewals. So we wanted to extend that a little bit with some examples. So let's say a town enters into a 12-month subpoena that renews automatically for an additional 12 months at the end of the 12-month period and annually thereafter. Is this a short-term subpoena? And based on the answer that Tina shared with you, the answer it's yes, because the maximum possible term of this contract is 12 months or less. If, on the other hand, a town enters into a 24-month subpoena that renews automatically for an additional 12 months at the end of the 24-month period and annually thereafter, is that a short-term subpoena? And the answer this time is no, because the maximum possible term, 24 months, is greater than 12 months. So the takeaway here is that the existence of automatic renewals does not by itself mean that a subpoena is short-term. It also requires the evaluation of the non-cancelable term. And if that's longer than 12 months, the presence of automatic renewals does not affect the evaluation of the maximum possible term. The omnibus statement from last year, Statement 99, includes a couple of provisions that are specifically related to subpoenas. The first is a clarification that an option to terminate is an unconditional right. So what that means is that if a provision gives a party the right to terminate only under certain circumstances or upon the occurrence of certain events like failure to pay, that's not an option to terminate for the purposes of determining the subscription term. The second provision is that a subpoena that previously had been determined to be short-term and that has been modified to extend the initial maximum possible term should be reassessed from the inception of the subpoena and not from the date of the modification. So, for instance, if a government has a 9-month subpoena and in the 6th month, it modifies it to add 6 more months, in other words, a total of 15 months, then the government, in reevaluating the maximum possible term, should look back to the inception of the subpoena, which would result in it concluding that the term is now 15 months, which is longer than 12, and so this would no longer be in this case, would no longer be a short-term subpoena, and the government would have to determine the subscription term and measure a liability and a subscription asset. There are a couple of aspects of the measurement of the liability, a couple of things in the list in Statement 96 of things that should be included in the measurement of the liability that raise a lot of questions. One of those is variable payments that are fixed in substance, and the other is any other payments to the vendor that are reasonably certain of being required. So let's say a subpoena contract requires a municipal hospital to pay $250 per subscription user above 100 should that fee be reflected in the subscription liability? The answer is no, because variable payments should be included only if they're based on an index or rate, or if they are fixed in substance. Let's say instead that the SBTA contract requires the hospital to pay a minimum of $50,000 for up to 100 subscription users and an additional 250 per user above 100. Should either part of that fee be reflected in the subscription liability? And the answer is that the $50,000 represents a variable payment that's fixed in substance. That should be reflected in the subscription liability, but not the additional $250 charge per user above 100. Mixing it up again a little bit, let's say that that contract requires the hospital to pay $250 per subscription user, and there is no minimum payment required. However, the hospital is reasonably certain of the number of users it's going to have based upon the usage of its existing software in the past. So should that fee, as a result, be reflected in the subscription liability? And the answer is no. Even though measurement of the subscription liability should include other payments to the vendor that are reasonably certain of being required, this fee is a variable payment based on future performance, and those are excluded from the measurement of the subscription liability. And then one last one in this area of expected payments. A water and sewer district enters into a 3-year contract for 150 handheld devices that utilize the software for reading meters and transmitting usage information to the district's billing system. So in this case, the district must have concluded that that this arrangement that has both IT software and hardware, that the software is more than insignificant relative to the cost of the hardware. And so it should be accounted for under Statement 96. The contract requires that the district pay $50 per device when they are returned at the end of the contract. Should that fee be reflected in the liability? And the answer is yes, that this is an example of a fee that is a payment to the vendor that is reasonably certain of being required. And then the last topic I'd like to cover related to implementation of, the second to last. We're getting close to the end, folks, and then we'll take some time to answer some of your questions. Incentives is an area that seems to cause some confusion as well. For one thing, it's not clear to some people that incentives include not only payments that are made directly to the subscriber, but also payments that are made on behalf of the subscriber. So incentives not only include rebates or discounts, but they also might include the paying off of the subscriber's pre-existing subscription obligations, as well as things like free periods, reductions of interest or principal, and so on. So the way these should be dealt with, incentives, is if they are provided to or on behalf of the subscriber before the subscription term starts, the incentives should reduce the initial measurement of the subscription asset. On the other hand, if the incentives provide payments after the subscription term starts, they should be incorporated into the measurement of the subscription liability, presuming, of course, that they are fixed or fixed in substance. For example, a township makes payments to a vendor of $10,000 and receives incentive payments from the vendor of $5,000 before the subscription term begins. So that township should account for this by subtracting the incentive payments received before the subscription term from the subscription payments that it made before the subscription term. So the net difference there is $5,000. The prepayments were greater than the incentives, and that $5,000 would directly reduce the initial amount of the subscription asset. If we flip those numbers so that the township has made payments to the vendor of $5,000 and has received incentive payments from the vendor of $10,000, so the incentive payments are greater than the prepayments by $5,000, how should that be accounted for? And the difference should be accounted for as a liability until the term commences. And at that time, the liability is reclassified and the asset is reduced by that amount. And then the last thing we'd like to talk about with respect to 96 is the implications of a change in existing implementation guidance in the comprehensive implementation guide that was included in the 2021 implementation guidance update, and which is effective for fiscal years that ended this past June 30th and later. So what this question originally said, it deals with a government's capitalization policy and asks the question, should it be applied only to individual assets, or can it be applied to a group of assets acquired together? And the previous answer said that existing authoritative pronouncements don't address the manner in which a capitalization policy should be established. And so it may be appropriate for a government to have a capitalization policy that would require capitalization of certain types of assets whose individual acquisition costs are less than the threshold for an individual asset, but that cumulatively are greater than the capitalization threshold, that are significant as a group, and a government could recognize those as capital assets based on that policy. Implementation Guide 2021, implementation update from 2021, basically does a 180 on the capitalization policy question, and says that governments should capitalize, and as you know, should in GASB standards means must, should capitalize assets whose individual acquisition costs are less than the threshold for an individual asset if those assets in the aggregate are significant. So, a group of, as in the example in this, of computers or classroom furniture or library books could be significant collectively, and therefore, if purchased together, the government should capitalize them together if they are in the aggregate significant and exceed the capitalization threshold. And as a matter of practical application of both the leases standards and SEBITA's, SEBITA liabilities that are significant individually or in the aggregate should be recognized regardless of whether the related subscription asset meets an established capitalization policy. So even if the capitalization policy doesn't require the subscription asset to be capitalized because it's below the established threshold, that doesn't necessarily mean that the liabilities, if they are significant, shouldn't be recognized under Statement 96. And second, when applying a capitalization threshold to SEBITA's, one should consider the quantitative and qualitative significance of the liability in addition to the significance of the asset. And there's some relevant guidance in Comprehensive Implementation Guide question 7.4.1.
Dean, one of our questions that came in is actually kind of related to this. They asked, is there a materiality threshold for GASB 96 like there is for GASB 87?
Well, there is a materiality threshold for every GASB statement. You may notice that at the end of the standard section of every statement, there's something that is referred to as the materiality box. That's not an official name. It's just what it's acquired over time, because that box says that the provisions of this statement need not be applied to immaterial items. So all GASB statements only apply to material items. That being said, if the question really is, should a government have a capitalization threshold for subscription assets, the answer is definitely yes. And that will affect whether it is capitalizing the subscription assets. But as this first point here should make clear, that doesn't mean that, well, since it doesn't meet our capitalization threshold, we're not going to recognize the liability. Those are two entirely separate evaluations that need to be made.
And real quick, when would the new question 7.9.8 apply? What date? I think you kind of
It
mentioned it.
fiscal years that ended this past June 30th and later. So if you're a government in Alabama or Florida, for instance, that has a fiscal year ending later this week, that question, that change in the capitalization threshold guidance applies to this fiscal year.
All right, and our last polling question number 8. Which of the following is true about capitalizing groups of assets whose acquisition costs are significant in the aggregate? A, it used to be required, but now it's not. B, it used to be a matter of professional judgment, but now is required. C, both A and B. Or D, neither A nor B.
The answer to question number 7, by the way, was statement 101 on compensated absences is not based on the same underlying recognition model as leases, P3s, and SEBITAs. Do we have time for a couple of these questions?
Yes, I think we do. Another materiality question: is materiality at the individual fund level or as the government entity as a whole?
Well, feel free to correct me on this, Becky or Tina, but I'm pretty sure that you have to evaluate those, separately for each reporting unit in the
That's correct.
financial statements.
It's at the opinion unit of the financial statements that it would determine its materiality.
All right, then I'm going to go back to a question that's been out for a little while. Would an agreement to provide access to financial data fall under SEBITA guidance if the software component of the agreement is incidental to the data that is accessed?
So I presume that this question, implicit in it, is saying that there's a hardware component that, maybe it's like a Bloomberg terminal. So my answer to this question is not an answer at all, which is I need a lot more information to evaluate whether the access to the data and the things that the software allows you to do with the data, may in fact be, significant relative to whatever the leasing cost is for the terminal. If there's no hardware portion at all, then the issue of significance of the software to the hardware isn't an issue at all. There's a question here about separating subscription costs from support.
Yes.
There is guidance in statement 96 that is very similar, if not identical, to what's in 87 for leases for contracts that have multiple components, and in particular, in the case of 96, where some of the components are subscription components and some are not. So for instance, there may be a subscription component, something that is definitely a SEBITA, and another part of this contract involves IT support being provided by the vendor, or supplies related to the software, or maintenance of the hardware if there's hardware in the contract. And what the basic requirement of 96 is similar to what 87 requires, which is the two parts should be separated, and the subscription component accounted for under 96, and the other component that's not a SEBITA should be accounted for under whatever the relevant guidance is. That's presuming, of course, that the pricing information is available for those two components to be measured separately. And statement 96 provides guidance on how to do that if it's not explicitly stated in the contract, and talks about things like maximizing observable inputs and so on. But there is ultimately an exception in 96, just as in 87, that if it's not practicable to price those components separately so that you can apply two different statements to measuring them, then the entire contract should be accounted for under Statement 96 as a subita. But I would remind everybody that practicable is a very high bar, and as GASB emphasizes in the basis for conclusions of every statement now that uses the phrase practicable, practicable means something much higher than inconvenient or hard to do.
And one more question that we have, are subscriptions for ebooks or e-magazines considered GASB 96? This particular participant decided not to include these as they felt that they were, do not technically have control over the subscriptions compared to the technology subscriptions in their finance system or learning subscriptions used by teachers to evaluate student learning. However, they've been getting some conflicting information on whether they should be included or not. And obviously this you'd have to probably have some more information, but just in general, if you can give a little more guidance.
But that is a great question, and is one that comes up a lot, and one that I when I do longer presentations on 96 implementation, I usually address, but I didn't include this time because of time constraints, and also because it's a question that I can't definitively answer. But the person who posed the question is focused on the right aspect of 96, which is the definition of control. And there are two criteria, both of which need to be met in order to have control over the right to use the subscription asset, just as is required for control over the right to use the lease asset in Statement 87. And depending upon the provisions of things like subscription contracts, say you're dealing with a vendor that provides online access to 200 periodicals. Control will ultimately come down to what you're able to do with that subscription. Can you pick and choose, which periodicals are available in your library or your school, for instance? And if it can, does that constitute control? That it's not explicitly defined in that manner with that example in Statement 96. So it still is going to be a matter of professional judgment. But the fact that the person who asked that question was looking at other things that they have subitas for and the degree of control they have over those, and saying, man, we have nothing like that, may be a path to answering that question. But the fact that it's less control or it's not quite the same control doesn't mean they don't have control. And so they still are going to need to make an evaluation as to whether they meet that criteria.
And I would normally direct, if I had a client such as that, I would normally direct them to either a consultant or their auditor to help them make that determination.
Or the GASB. Because you can ask the GASB questions, and if you give them a sufficient amount of detail about your facts and circumstances, they may very well be able to help you answer that question.
Great. Well, we have answered all of the questions that are in the Q&A.
And the answer to this polling question is B. It used to be a matter of professional judgment, and now it's required.
All right. Well, thanks so much to Dean and Tina for that very informative presentation. Do you guys have any additional thoughts before we close out?
Not me. I think everybody probably wants to go eat lunch.
I was thinking the same thing.
All right. Well, thanks to all of you for joining us today for the 2023 GASB update. Don't forget to check out the government and public sector industry section of our website for more content, including a large volume of content on deferrals that Dean has put together subsequent to our previous deferrals webinar. And he is constantly assisting us with putting out new content as things are, new GASBs are being issued, and we determine that there are new things that need to be addressed to help you understand what's going on in the government industry. So thank you all for joining us. We hope that this was informative, and we hope to see you soon at another CRI webinar event.